Hello, my name is Gaurav Menon. Welcome to Prime Investor's Q&A session. Prime Investor is a research solutions platform for retail investors. It is a low-cost, no commission, no ads platform with the sole objective of providing unbiased investment recommendations to investors. Learn more about us in the link below. Today, I am joined by our co-founder, Vidya Bala, to answer a few questions from our Prime subscribers. Hello, Vidya.
Hi, Gaurav.
So let's get on with the first question. First question is it the right time to start a new SIP for long term, say more than 10 years, or should I wait for some correction in the market?
Right. So given where the markets are today, it is natural for most investors to ask this question. But since this particular investor who has asked this question says he has a time frame of more than 10 years, and the way to invest for him is SIP, I don't think there is any cause for worry. The idea of SIP is to reduce the element of market timing. So if you're going to start investing now, you would obviously go through various ups and downs in the market, and that would provide you sufficient time to average. So instead of worrying, whether this is the right time and delaying your investments and thereby reducing your compounding effect, you would be better off starting today. Probably if the markets do correct and you keep aside some to kind of deploy at such times, you could add more to your SIPs running. You could additionally add when the market falls. That would be a good way. So don't delay investments, start them.
Now the second question. There is a school of thought which feels that small cap stocks are not suitable for SIPs and timing is required for good returns. What is your opinion?
Timing is required for any kind of returns. Although we all keep saying, let's stay timing agnostic, etc. End of the day, an element of timing. When I say timing, it's not about when the market is at a peak or at a low. It's about finding the stocks with the right value where there is sufficient upside. And that becomes more important in stock investing. And therefore, it is necessary for every investor to catch a stock. So you may filter your set of stocks and keep them, but you need to find the right price point to enter them. So that is where, end of the day, the returns, the upside lies. So to that extent, not just in small cap, even in large and mid caps, timing is an element. But at the same time, there are stocks where you would have missed good opportunities simply because you were waiting for a correction. So that should not be the case. As long as you're able to identify quality stocks, the way to do it would be to kind of invest some and then see if you get averaging opportunities to invest more. So there are, so the argument is to away from timing. You need to time to an extent that your upside depends on timing, and it's not true of just small cap. And the way to do it would be to identify good stocks and see if you can start investing and try to accumulate them over time.
Now, the third question is, I read your article on debt funds. Can you please answer my question that for good quality PSU, corporate and short-term funds, what can be the worst case scenario? Any chances of these funds going down 3 to 7% like it happened in the past, or will they be stable with a little downside?
Right. So past performance can always repeat itself, right? And that's true of mutual funds too. The markets, it's all a cycle. So when we say a cycle, everything repeats itself, and it's very, very true of debt funds, which go through interest rate cycles. So the funds that you just mentioned, short-term debt funds, banking and PSU, corporate bond, all have an element of interest rate risk in them because they're not very short-term in nature. They have a duration of somewhere around 2 to 3 years. To that extent, you will definitely find volatility in them. So the way to gauge, which ones are more volatile is to look at their average maturity. If they have a longer average maturity, they are more sensitive to interest rate moves. So among the debt funds that you just read out, the corporate bond, category does have slightly longer maturity. And since we are just getting into a stage of interest rate up moves, if not interest rates, the yields at least are moving up. you will definitely see volatility, maybe not 7% by the like you just said, but there will be volatility. And this is why at PrimeInvestor, we try to categorize funds, bucket funds based on time frames. So if you go and visit our set of recommended list of funds, which is prime funds, you will find that we have, very short term, and we mentioned the time frame there, 3 to 1.5 years, 1.5 to 3 years. As long as you pick those funds which fit your time frame, you should not worry about the volatility. There might be a few months of 1%, 2% loss, but that does not matter if you're a 3-year plus investor, right? So as long as you pick the right category of funds, and you will find that corporate bond funds, for instance, are at a higher time frame category at prime funds more than the short duration or the banking and PSU funds. So check them out, and as long as you stick to the time frame, you should not have a problem.
Let's move on to the next question. Is the current offering of IDFC Gilt Index Fund 2028 a good opportunity to invest till maturity, or equivalent funds with better opportunities available in your opinion? Example, constant maturity gilt fund, etc. Please advise. Looking to invest before 31st March.
Right. So this is a very timely question, because we are currently the NFO of this fund is on, and this is a very novel fund. The IDFC Gilt Index Fund that you just said is a very novel fund, because it's one of the few target maturity funds and the first to use pure gilt. But what you should be aware of, clearly the credit risk is nothing there, because it's a gilt fund. Essentially, they invest in government securities. But what you should be aware of is that we are at the cusp of a rising yield stage, and that means longer duration funds. So this basically is offers a 6-year and a 7-year tenure, and that's not short. Longer duration funds will definitely have short to medium term losses. Right now, the 6 and 7-year has been chosen by this particular fund house simply because the yields are at present more attractive in the 6 and 7-year than the 10-year. So to answer your question on the constant maturity funds have a 10-year duration, and the yields there are slightly lower than the 6 and 7-year. This is a temporary phenomenon, and it may not last long. And therefore, at this juncture right now, 6 and 7-year does look attractive for lesser volatility. And that's where the money is to be made. But if you have, say, a 10-year time frame, 7-year plus time frame, they will even out. So your constant maturity will still look better in that sense. But if you're going to align your time frame to 6 and 7 years, at this juncture right now, this option does look good. And yes, if you invest before 31st, you get an additional year of indexation. So it makes a lot of sense. Please read our article published today, that is the 19th of March, on this particular subject. We have in detail covered this fund.
Thank you, ma'am. And now the final question for today. I'd like to stay 100% equity since I've had a very long time frame. So instead of a debt fund for 20%, can I allocate the 20% to any passive funds? If so, what do you guys suggest?
Okay. So essentially, by going 100% in equity, you seem to suggest that you can take a lot of risks. So, of course, it's entirely up to you to understand whether you can take market hits. If you can do that, yes, by all means you can. But please remember, when you take 100% debt, the question of rebalancing your portfolio becomes a little more harder, because you don't know vis-a-vis your debt how much your equity has inflated and whether you should bring it back to the same level. It's a little more harder to take that decision. However, if you decide to go 100%, yes, passive is a good way, because you can monitor less and you can build a portfolio of index funds, equity index funds, through the passive route. You can check out, we have our ready to use portfolios. You can check them out. You will have something called passive investing portfolios, where you have index funds and ETFs. We have built an entire portfolio out of those. You will have large caps, you will have mid cap, you will have new index like the next 50, and you even have an amount of international flavor too. So it's quite possible to build a very holistic portfolio with different styles, even with passive investing. So check them out. if you don't want it and you just want the choice of funds, in Prime Funds, this is a list of recommended mutual funds. We have a section called passive investing where we list out various quality indices. When I say quality, those with low tracking error, those with low expense ratio. So we have already done all the groundwork for you and put it out there. You can check those out too and build your own portfolio if you would like.
Thank you, Vidya. That's all for now, folks. We hope you benefited from this Q&A session. We'll see you soon with more such sessions. Do visit our website and read more articles on mutual funds, stocks, deposits, ETFs, and insurance. Bye-bye.